Imagine this. How did you even get into investing back in the day? I can at least tell you how it happened for me. I stumbled upon the concept of financial freedom through countless bloggers from the USA who showed how they built their monthly incomes with dividends. How did you first hear about investing and what drew you to it? Since the start of my investing career over 10 years ago, I primarily bought individual dividend stocks. Over time, I realized that some were duds, some stocks lingered sideways, and others have significantly fueled my wealth growth. Curious to know, what does a €140,000 dividend portfolio look like, and how much dividend does it actually generate? Let's recap. How does a €140,000 dividend portfolio appear? And even more interestingly, how much dividend does it really provide? We'll also delve into my current stance on investing. And beware, there's a shock waiting for you at the end of this video. Want to know how my perspective has evolved and what surprising turn it took? Stay tuned. Music plays. Welcome to the video. As always, a quick disclaimer. Nothing here is financial advice. For personalized research, feel free to subscribe and hit the notification bell so you never miss a new upload. Ready to dive into the details of my dividend portfolio? Let's get started. So, what does my dividend portfolio actually look like? Taking a step back, how did it all begin? As I mentioned, I was introduced to investing through the American FIRE movement. What are the core principles of the FIRE movement, and how can they help you achieve financial independence? The focus was always on the same fundamental themes: enabling financial freedom through a long investment horizon where compound interest can fully work its magic, and spending as little money as possible to invest more. But how does this approach help in building wealth, and what are the potential pitfalls? The idea is to maximize income while keeping expenses low. Anything that remains should then be invested after building a small emergency fund. Eventually, your investments should grow to about 25 times your annual expenses, meaning the returns from your wealth would exceed your necessary expenses, granting you financial freedom. How do dividends, real estate, and bonds play a role in achieving this financial independence? In most cases, dividends, individual stocks, real estate, and bonds are the vehicles used. With dividend stocks, a company decides to distribute a portion of its profits directly to shareholders via dividends. In Germany, this happens roughly once a year, whereas in the USA, quarterly is the standard, and in some cases, even monthly. How can you build a steady income stream from dividends, and what factors influence these payouts? If you accumulate enough dividend stocks, you can create a stream of income that these bloggers diligently share, showing the rising numbers over the years, which motivated many to stay invested long enough. Which dividend classics should you consider, and how can they impact your wealth over time? As a new investor, I was naturally excited by this information and eagerly began accumulating dividend titles around 2014. I tracked them in my small Excel spreadsheet, which still sits on my computer today. As a European investor, I didn't just stick to American models. I also bought many German and European titles. What are the benefits and challenges of diversifying your dividend portfolio across different regions? In my dividend portfolio, you'll find well-known names like Allianz, Deutsche Post, Unilever, Shell, BASF, and so on. Over the years, I've repeatedly bought some of these stocks, partly through savings plans, or like Shell during the Corona period. How does reinvesting dividends and utilizing savings plans enhance your portfolio's growth? Moreover, being influenced by American bloggers, I also included absolute dividend classics like Johnson & Johnson, Altria, ExxonMobil, IBM, or Walmart in my portfolio. In the real estate sector, the classics like Realty Income, Omega Healthcare, and others should be familiar to most. How do real estate dividend stocks complement your overall investment strategy? In total, these stocks have reached a portfolio volume of €140,000, of which about €90,000 to €100,000 are personally invested, the rest being capital gains. All these titles have relatively similar values or purchase prices, with only two outliers: Nova Nordisk and Shell as larger positions. The rest range between €2,000 and €6,000 per position. What is the importance of having balanced position sizes in your dividend portfolio? Now that we know which stocks are in my portfolio, the next exciting question is, how much dividend is my entire portfolio actually paying out? I have diligently tracked each payment over the years in my Excel file. For example, Due to German payouts, they were initially the highest, and the number of dividends per year steadily increased, just like with American blogger colleagues. Here it ends in 2022, as I stopped tracking everything individually. Why do dividend payments tend to increase over time, and what impact does this have on your income? The good thing about dividend stocks is that often the payouts continue to rise even if you don't buy new stocks. For example, Allianz increased its dividends per share over the years, and my two purchases from over 10 and 8 years ago continue to provide rising dividends to this day. How does dividend growth contribute to the long-term sustainability of your portfolio? So, the current state. How many dividends do I receive? There are approximately 4,800 euros in gross dividends per year. Many of you might say, wow, that's not much for a dividend portfolio. But don't forget that about 42% of pensions in Germany receive less than 1,250 euros net per month. How does a 316 euro net dividend monthly income compare to the average pension income, and what does it mean for financial security? 316 euros net dividends per month for life isn't nothing. And even though 140,000 euros might sound like a lot initially, it's a sum that can be achieved by saving 500 euros a month with a 5% inflation-adjusted return over 15 years. Is achieving this investment volume realistic for new investors, and what steps can help you stay on track? Now that we've answered both questions about what my portfolio looks like and what it pays out, we move on to the next part of my current dividend strategy, and here comes the big shock. What's the shocking truth about my dividend investing strategy, and what lessons can you learn from it? First, a disclaimer. The topic of dividends is extremely polarizing. There are superfans and there are haters. As always, my message is that there is no black or white thinking. Everyone can do what they want, and there are different strategies and starting points. How can you determine which investment strategy aligns best with your personal goals and risk tolerance? Unfortunately, I have to tell you that I made a big mistake by blindly sticking to dividends for too long. I didn't pay attention to ETFs, growth stocks, and other investment options. My only focus was building passive income through dividend stocks, influenced not only by US bloggers, but also by some well-known investors. What are the potential downsides of focusing exclusively on dividend stocks and neglecting other investment opportunities? Phrases like, dividends let you sleep peacefully, or just hold through the crashes because dividends keep coming in, suggest that this is the ultimate strategy. But how did this belief impact my investment decisions and portfolio performance? In my eyes, I simply wasn't acting rationally. Being rational in investing means focusing on numbers, facts, and data, not emotional decisions just because they might feel better. What does rational investing look like, and why is it crucial for long-term success? Thus, I walked through the following thought process. Why do I buy dividend stocks? Because they bring passive income and payments that motivate me towards financial freedom. But what happens when you need this income immediately? I realized that if I ever need this income, I would have opportunity costs, neglecting other investments just because I was focused on dividends. What are the opportunity costs of focusing too narrowly on a single investment strategy? Moreover, was I even adequately diversified? Definitely not. I had around 30 dividend stocks, often facing cases where 2 or 3 companies had problems, causing my entire portfolio to suffer. How does lack of diversification amplify the risks in your portfolio? Returning to the topic of opportunity costs. How do you maximize stock market returns through dividends plus capital gains as a rational investor? As a rational investor, it should be completely irrelevant whether these returns come primarily from dividends or from capital gains. The only goal should be to maximize the formula in a way that delivers the most sustainable and highest return over a long period. Don't get me wrong, dividends aren't inherently bad for returns. Almost 40% of the returns from a broad index like the MSCI World come from dividend payments. How can you balance dividend income with capital appreciation for optimal portfolio growth? Many of the largest companies in the world pay dividends, such as Apple, Microsoft, Unilever, or Broadcom. How do dividends from these top companies impact the overall performance of index funds and ETFs? Let's look at this comparison. MSCI World Price Index without dividends versus total return with dividends. Why is total return a better measure of investment performance than price index alone? Now compare two standard ETFs focused on dividend stocks alongside a broad market ETF. What does this comparison reveal about the performance of dividend-focused ETFs versus broad market investments? Here you can see the last 5 years. The MSC World Total Return is almost plus 80%, twice as high as the last Vanguard ETF, and the dividend-focused ETFs perform 12% below. What lessons can you draw from the underperformance of dividend-focused ETFs compared to broad market indexes? Even worse, when I add my individual dividend stocks to this comparison, except for Walmart, none of the stocks have managed to outperform the MSC World. Why did my concentrated dividend portfolio fail to keep up with a broad market index, and what can you do differently? The black line represents the zero line. Everything below it even had a capital loss in the last 5 years. What does this tell you about the risks of relying solely on dividends in a volatile market? This is extremely bad, especially in a period where almost all broad market indexes and products have been on the rise. How would a market downturn affect a concentrated dividend portfolio compared to a diversified index fund? So, it's fair to say that if my 18-year-old self hadn't focused purely on dividends and cash flow, but had instead invested in a broad market ETF, I would be much further ahead today. What are the benefits of investing in broad market ETFs over concentrated dividend portfolios? I have significantly underperformed the market, and on top of that, I had many emotional headaches, high fees from individual purchases, and time invested in managing dividends and foreign tax reclamation. What emotional and financial costs come with managing a concentrated dividend portfolio? But complaining doesn't solve anything. What steps did I take to rectify my investment mistakes and improve my portfolio's performance? So, what did I do next? Something that might come as a shock. I started dismantling my dividend portfolio and selling off